Good evening, everyone. Hope you all are doing great and
Good
hope
evening. Doing
good
great.
evening. Hope the subject is going great at your end as well. And that is going well at your end only when you are regularly reading it, analyzing it, trying to find out what is and what is not matching with your concepts and understanding. So, let me first handle your issues, if any, before I take up the matter further. Anybody, any queries or doubts in the topics that we have discussed till now in this subject of direct tax laws, in particular capital gain, other sources? But yes, if there are doubts for any other topics also, you may please put it forward so that we can take up your queries. Yes, students, give me some inputs. Geet says no doubts. That is hard to understand because the topics are not that straightforward. So it indirectly means that maybe you all have not gone through the details of the topics yet. Means you all have not started studying at your end. Okay, let us proceed. So we are dealing with the topic of taxation of income from other sources head. I had explained that this head, though termed as a residuary head, but two things have to be kept in mind. One, it is not a dustbin. So anything which is not covered in other four heads automatically cannot fit over here. It has to first pass through the test of income under 224. Second important thing is, even though we call it as a residuary head, but it also has its own identity, which means that there are specific incomes which would be taxed under this head only. Like we saw dividends, like we saw gifts, like we saw uh, amount recovered against a capital asset where the deal could not be materialized and you retained the advance received. So these are some of the very typical example. Then casual incomes like winnings, betting, gambling, etc. So these are some of the common items. And then in the previous class, we started discussing this point where there are some incomes which has implication in multiple heads. So here, this part is where conditionally the law says that if it is not falling in that other head, then it would fall under other sources. So there are incomes which are parallelly falling in PGBP. There are incomes which are parallelly falling in salary. So this is the part which we were discussing in the previous class. In this, one of the incomes is interest on securities. Now, when it comes to interest on securities, we have to remember this section 10 clause 15 list, because this 10 clause 15 says that there are certain interests which have been made exempt, and since these are made exempt, that is why there will be no tax whenever you earn income from one of these sources. Now, if you read this list, you'll find that one thing is very common. That one thing which is common is the usage of the word notified or the usage of the word specified. So, wherever you are getting interest from any such securities, investments, debentures, bonds, where those investment options are either notified or specified by the government, then you can very safely presume that that would be exempt. So this is one of the small tricks how you can be comfortable with such a huge list, though it is very important that you also go through it. Next is this particular point, that is the compensation to be received by the victims of the Gopal gas tragedy. I'm sure you all would be knowing this. So if this compensation is received late, even the interest received for that compensation would be exempt. Then again, interest on gold deposit bonds, which are issued under the deposit scheme, again, which has been notified. Then you'll find this word specified or notified being repeated. Correct? Then comes one of such sources which is taxed under three heads. That is Keyman insurance policy. So, Keyman insurance policy is such a source which may be taxed either under salary or under business head or even under other sources head. Now, the question is, if it is taxed under all the three heads, how to determine when it will be taxed? Firstly, I hope you all know what is a Keyman insurance policy. A Keyman insurance policy means where the business is taking policy on the life of that person who is the most important, most significant, most, I will use the word critical to the success and survival of that business. That person is called as your key person or key man. The person may be an employee, the person may be a director, the person may be the partner, even the owner, shareholder, anybody. Now, when this particular policy amount is not policy amount, sorry, the premium amount is paid. If you remember, section 37 of PGBP head allows deduction. So interestingly, this is only the life insurance premium for which the business head is allowing deduction. Why? Because they are considering this policy as a business policy. I'll give you another practical example of this. I'll link it with accounts. Which chapter? Yes. If you recall the partnership accounts, in partnership accounts there was a concept called as joint life policy, where a life insurance policy was taken on the life of the partners, so that if any partner is retiring or there is a death of the partner and you need to pay the lump sum amount due to the partner, they could realize it through the joint life policy. That is also an example of Keyman insurance policy, and nowadays this is very common in businesses. So whenever a business is taking a Keyman insurance policy, section 37 is allowing deduction for the premium paid. Otherwise, life insurance policies are personal, so you do not get deduction under PGBP. Fine. Now, when this policy is matured or when the policy amount is due, it is taxed depending upon who is receiving the policy amount. Yes, Geet, you're right. So, where the policy amount is paid to the employee, employee will be paying tax under the head salary for the amount of policy. And if you recall our previous class where we were discussing about the insurance receipt, we also discussed about section 10 bracket 10D, that is section 10 clause 10D, which gives exemption for insurance premium, sorry, not premium, the insurance policy amount which you receive on the maturity of the policy. However, there were exceptions where certain policy amounts would always be taxable, and Keyman is one of them. So for Keyman insurance policy amount, there is no exemption under 1010D. Now, if the employee receives as per the policy contract, then in the hands of employee, whatever is received, it is taxed as the salary income. If the business receives, when I say business, means if a company has taken the policy, the company receives. If the partnership firm has taken the policy, the partnership firm receives. So if the business receives, then it is taxed as a business receipt under section 28, that is under the PGBP head. And if the director receives, who is not an employee, or if on the death of the partner, director, or employee, the family members of these persons receive, then it is taxed under the head other sources. So this is how the taxability happens of the policy amount received under Keyman insurance. And then the fourth category is residual. Any income chargeable tax but not falling under the other heads of income shall be charged under this head. So some examples are given, like salary received by MPs, MLAs. It is not charged under the head salary. Why? because the members of parliament stand in the capacity as a trustee and not as the employees. Similarly, where directors receive remuneration and not salary, that is also taxed under the head other sources. Now, there are some important clarificatory aspects. Let us deal with them. So, who will do the reading today? Yes, who will do the reading today for me? Mm, yes, we'll just wait if otherwise, Keith, you can take up. Yes, Geet, go ahead.
Interest from non-SLR securities of bank, whether chargeable under the head profit and gains of business or profession or income from other sources. The issue addressed by the circular is whether, in the case of banks, expenses related to investment in non-SLR securities need to be disallowed under Section 57(1) by considering interest on non-SLR securities as income from other sources. Section 56(1)(1)(d) provides that income by way of interest on securities shall be chargeable to income tax under the head income from other sources if the income is not chargeable to income tax under the head profit and gains of business and profession. The civility clarified that the investments made by a banking concern are part of the business of banking. Therefore, the income arising from such investment is attributable to the business of banking falling under the head PGUB.
So, what is clarified? That the investment made by a bank are part of the banking's business. Therefore, income arising will always be categorized under the head PGBP. So, if you remember, we had discussed this point in the previous class also, that you have to check what are your trade and what are your non-trade investments. So, whatever are your trade investments, that will always be falling under PGBP, and the incomes from such trade investments will fall under PGBP only. Now, we come to the very important part, that what is the tax rate applicable? Now, the tax rate generally for income falling under other sources is the regular tax rate. So, if you're individual, it is the slab rate. However, for certain incomes, there are some special rates prescribed. So, let us read the rates. Please go ahead.
Applicable rate of tax in respect of casual income, Section 115BB. This section provides that income by way of winning from lotteries, crossword puzzles, races including horse races or card games and other games of any sort, or from gambling or betting of any form, would be taxed at a flat rate of 30% plus surcharge if applicable, plus health and education cess at the rate 4%.
I hope you
However,
all know
income
this, that as far as the winnings part is concerned, it is liable to tax at a flat rate. There is no concession in that. Importantly, as you can see, there is no deduction allowed either for any expenditure or for anything. So there is no adjustment allowed. It means it is taxable gross. Further, even chapter 6 deductions are not allowed to be adjusted. Also, wherever slab rates are applicable, you have the basic exemption limit. Now, the rule, if you remember, we discussed this in capital gain also, that if you are not able to adjust or utilize your basic exemption limit against regular incomes, you can utilize it against special income, and it was allowed against the capital gains. However, it is not allowed against this winnings income. So, winnings is taxable gross in simple words. Yes, please proceed. Next.
applicable rate of tax in respect of winnings from online games, Section 115BBJ. This section provides that net winnings from any online game would be taxed at a flat rate of 30% plus surcharge if applicable, plus health and education cess 4%. No expenditure or allowance can be made from such income. Deduction under Chapter 6A is not allowable from such income. Adjustments of unexhausted basic exemption limit is also not permitted against such income.
So it is replica of the above section because it is also like winnings only. So it will be taxable gross without any deduction, without any allowance. Yes, please proceed.
Meaning of certain terms. Internet means the combination of computer facilities and electromagnetic transmission media and related equipment and software comprising the interconnected worldwide network of computing of computer networks that transmits information based on a protocol for controlling such transmission. Online game, a game that is offered on the internet and is accessible by a user through a computer resource, including any telecommunication device.
So basically, they are trying to define what is online game. So the game which is through online medium, that is internet, is covered in online game. And what is internet? Then they have defined internet. Fine. Now comes the very important part. Now, when we deal with any head of income, be it salary, HP, capital, etc., you always see that first you take the receipt falling under that head, and from that receipt, you subtract whatever expenses the head allows you to deduct. Now, here, what is important is if you see salary head has allowed only three deductions. Now, for the time being, I'm keeping aside the new scheme and the old scheme difference. Just broadly, if I say salary head allows you only three deductions. Similarly, PGBP head also allows you only three deductions: municipal tax, then standard deduction, interest, again, depending upon new scheme, old scheme, and also depending upon whether it is self-occupied, let out, etc. Business head is the most generous head, which allows you deduction for virtually all business expenses with some restrictions on few expenses. Again comes capital gains, which again allows you deduction only for three items: expenses on transfer, cost of acquisition, cost of repair. Then comes other sources. Now, when you see other sources, you can just keep in mind that other sources is similar to PGBP when it comes to computation. So even other sources allows you deduction. This we will see in section 57, but then you have 58, which restricts deduction for some of the cases. So since now other sources would be covering a list of many receipts, many sources of income, the generic rule for other sources is that you will be claiming deduction for majority of those receipts or incomes on similar lines like PGBP head. That is, you have to just ensure or satisfy the condition that the expenses are incurred for the purpose of earning that particular source. That's it. And it is not capital in nature, it is of current year. That expenditure would be allowed under 57. However, for few items in other sources, there is some restriction, there is some limitation that we have to keep in mind. And the first and the most important one is dividend. But before dividend, you have to just keep in mind the above two cases which we discussed. One is for winnings and one is for online. For both of them, no deductions are allowed at all. So both of those receipts are taxable gross. Now, for all other receipts, we have 57 and 58 that will guide us as to what is allowed, what is not allowed. In this, you have to just focus on those few items, like, for example, the dividend and two more that you'll get further, where there is some restriction on deduction. Remaining all other receipts falling under other sources follow PGBP principles for deduction. Please, we may start.
Deductions allowable, section 57. The income chargeable under the head income from other sources shall be computed after making the following deductions. First, in the case of dividend, other than deemed dividend arise on account of buyback of shares by a domestic company, or income in respect of units of a mutual fund specified under section 1023D, or income in respect of units of a specified company defined in the explanation to section 1035. Interest expenditure to earn such income is allowed as a deduction subject to maximum of 20% of such income included in the total income without deduction under this section. No deduction in respect of any expenditure is allowed in case of deemed dividend arise on account of buyback of shares by domestic company.
Let me first talk about the buyback part. In the previous class itself, we had seen the working. So when it comes to the buyback part, just see. So whenever it is the case of buyback, you have purchased some shares of a company, which now the company is taking back from you under the buyback scheme. Now, even though you have purchased the shares, so there is some cost, but that cost will not be deducted while computing the income from other sources. So from other sources, under other sources, now the deemed dividends covers 222F, whatever receipts you get at the time of buyback. the entire receipt is considered as your other sources income. Now the question is, what happens of the costs that you incurred for purchase? They are saying that we treat it as your capital loss, which you can adjust or set off against your other capital income subject to the conditions of section 71, 72 and 70 that deals with carry forward and set off of losses. So the point is that when we talk about this deemed income, which is in the nature of buyback, there is no deduction allowed at all. Now, when we talk about the other incomes, other dividends, other than the buyback, there is allowance for deduction on account of interest. And there is a capping that the deduction on account of interest cannot be more than 20% of such income. Such income means the dividend income. But then there is a question that comes to your mind that we are talking about dividend income, and against that, we are allowing them to deduct interest. But interest, how can it be expense when it comes to a source like dividend? So for this, let me explain you what is the intent of this particular point. So what the law is intending or what the law is proposing in this particular provision is that if you have taken loan, that is, if you have raised the money for investing in shares in the form of a loan, it may be bank or private loan, whatever it is, and there is some interest expenditure, then we will allow you deduction of that interest, because until unless you arrange money, you cannot invest it in shares and you cannot earn dividend. Hence, for earning the dividend, the expenses attributable is the expenses that you incurred for raising that money, raising that funds. That is where this deduction comes into picture. Now, this limit was not there until few years back. So it was introduced few years back only. Why it was introduced? You have to understand the reason. See, as I gave you the background, other sources income, majority of the other sources receipts are allowed deduction on same lines like PGBP. Now, if you remember PGBP head, it says what will be allowed as deduction. Firstly, it gives you list in section 30 to 36 of specific expenses. And then the most important section comes, which is 37, which opens up the world of expenses for you. It says that you have to just ensure the expenses are incurred in connection with business. Second, it is revenue in nature, not capital, and it is pertaining to that particular relevant previous year. That's it. If you satisfy those conditions, then any expenditure you can claim as deduction. Now, please understand this point. This is one of the tools. Now, I'm firstly talking about PGBP, which has been misused by taxpayers to manipulate their PGBP income, to claim fake expenses, to claim expenses which are actually not genuine or not real, just to evade tax by showing lower income. Now, I just mentioned that a similar provision is there for other sources income calculation. Where you will proceed, you will see that the last clause of this section 57 also says the same thing, that you can claim deduction under this section of any expenses which are incurred for earning that income. Now, because of this clause, which makes it parallel to the PGBP section 37, people started misusing it, and again they started claiming any type of expense which may not be real, which may not be genuine. And then came the role of section 58, which put certain restrictions. And when we go to that section, you'll find that the restrictions are very similar to the restrictions that you find under section 40, various clauses under the head PGBP. So the same logic is continued over here under section 58. Now, when this dividend, now earlier, if you remember, I had mentioned in the previous class, earlier dividend had a special tax treatment. Originally, the dividends tax was paid by the company itself. So the company which is declaring dividend was paying tax on the dividend itself. So in the hands of shareholder, it was anyways exempt. So there was no question of any deduction or anything in the hands of shareholder. But few years back, they changed the mechanism and they said, no boss, now let the shareholder pay tax on the dividend. And if you see, in past few years, especially since COVID, there is a new whole line of business or a new whole line of activity whereby people are now regularly trading on the share market portals in various MCX and all these commodities and securities they're trading. Now, when a person is engaged in trading like a business, the income that the person will get from the buying, selling, or from the intraday, etc., is all part of PGP, no doubt. But whatever shares the person is holding, even though the intention of the holding the shares is for trading, but dividends on those shares will still be covered under other sources because of the specific inclusion of dividends under section 56 subsection 2. I had mentioned this in the previous class also, that don't treat other sources only as a dustbin. So 56 subsection 2 is a specific section which gives you a list of what items will be compulsorily taxed under other sources, irrespective of how they are arising or accruing. Dividend is the very first one in 56.2. Now, this particular provision came up when the lawmakers found that people are now having good portfolio and they are regularly rotating the portfolio and they are earning a decent amount also from dividends. And similar to the PGBP logic, what people were using for manipulating business income, they have started manipulating the dividend income also, thereby not paying tax on the dividend, which is substantial, which is running into multiple lakhs for many people. Hence, to shield that activity for dividends, they have brought in this particular point that what will be allowed as deduction in case of dividends will be interest only, firstly, and that also to the extent of 20% of dividends. That's it. Beyond that, we will not allow you any deduction against the dividend. This is what is very important point to understand, just the backdrop of why there is such type of a limitation. Fine, please proceed.
In the case of interest on securities, any reasonable sum paid by way of commission or remuneration to a banker or any other person for the purpose of realizing such interest on behalf of the assessee.
Now see, this point according to me is now old school. Old school means what? If you remember again in the previous class, I was explaining that earlier used to receive dividend warrants and all. Similarly, earlier for getting security interest, security means debenture interest, bond interest, again you were getting the checks or the warrants similar to dividend warrants. And earlier, you all know there was no internet or internet banking, online banking. So let us say I am staying in Maharashtra and the company is registered in Kolkata, company is registered in Ahmedabad. So they used to send me the checks, the dividend checks also, and the interest checks also with the bank account of the company in Ahmedabad, Kolkata, or wherever it is registered. And when I'm putting it in my Maharashtra bank account, my bank used to charge me a good amount of what you can say bank charges, commission, whatever it is, because they used to call it these things as outstation checks. And the bank, because there was no online, no internet, I'm talking 10, 15 years before. So the bank had to physically send those checks to that particular place or that particular company's bank and get it encashed. And it used to also take a huge time. Now, these were the common expenses which were levied or which were incurred in relation to realizing interest on securities. That is what they are trying to cover over here. But now these are very nominal because now everything is online. So even your checks are directly, no, sorry, no checks, the interest, dividend, everything is directly coming to your bank account. The company is also transferring it online. So they are now these all commission charges have gone. Now bank is only charging their regular bank charges and there is no specific charge for realization of interest. Yes.
Income consists of recovery from employees as contribution to any provident fund, etc. In terms of Section 224(10), deduction will be allowed in accordance with the provisions of Section 36(1) VA, that is to the
5A,
extent the
5A.
contribution 5A that is to the extent the contribution is remitted before the due date under the respective acts.
This was the last point that we discussed in the previous class, that the employee's contribution, which you deduct from the salary of the employee, as per section 224 is first considered as your income. And then If the employees are of your business, you get deduction under 36(1)(5)(a). And if they are employees, but you are not into activity of business and your income is covered under other sources, this section gives you deduction. Both the sections, 36(1)(5)(a) and 57, both put the same condition that we give you deduction only if this, that is the employee's contribution part, is deposited in the respective provident fund or ESI fund or whatever welfare funds are there by the due date of the respective funds act. If you miss the due date even by 1 day, we will never allow you deduction. So that is what is the point. Then the next part is where your other sources includes income by way of rental income or leasing income. Then what could be the leased out item? It could be the machinery, plant, furniture, which may be with or without building. Then what you get as deduction is the expenses incurred on those assets in the form of repairs, in the form of insurance premium, because you may have insured those assets, and where the assets are depreciable assets like plant, machinery, or building, the depreciation. Again, this depreciation, even though not specified here anything, it is calculated in lines with the PGBP section 32 depreciation. Then this is the next item which has some restriction or capping, that whenever you are receiving family pension, you get a standard deduction with a capping. Now, firstly, what is a family pension? So an employee has retired. If the employee is drawing the pension, it is taxed under the head salary only. But if after the death of the employee, like it happens in case of many government uh, employments, in case of military and all these things, up to a certain age or up to a certain period, the family members are also given the pension. So when the family members receive the pension, that is what is termed as family pension. It is taxed under other sources, and this is the standard deduction. Please read.
In case of income in the nature of family pension, a deduction of a sum equal to 33.33% of such income, or rupees 15,000 in case of optional regime, or rupees 25,000 in case of default regime, whichever is less, is allowable. The deduction is allowable both under the default tax regime under section 115 BAC and under the optional tax regime, that is normal provisions of the act.
So default
For the
regime means the new scheme where the higher deduction of 25,000 is allowed. Means the limit is 25,000 because the deduction is 1/3 of the pension up to a limit of 25 under the new scheme. And if you go for the old scheme, which is now optional, so the limit is 15,000. Now here they have further defined. Please proceed.
For the purpose of this deduction, family pension means a regular monthly amount payable by the employer to a person belonging to the family of an employee in the event of his death.
And then there are two
Exemption.
exemptions. One is under 1019 and one is 1018. So 1019 basically gives exemption where family pension is received by the family members of the member of armed forces, where the member had passed away during the course of its operational duties. So there is some war, there is some civil unrest, and that particular paramilitary force or the member of armed force was deputed over there, and because of that, the person faced some fatal injuries and the person passed away. So whatever pension the family members would be getting, that would be fully exempt. Second, where a person has received one of these gallantry awards, Paramveer Chakra, Mahavir Chakra, etc., then the pension received by the person till the person is alive or after the person's death, the family received by the family members, both are exempted. Then point 6 says, now this is that point which is equivalent to section 37. It says that any other expenditure which is not a capital expenditure and which is expensed wholly exclusively for earning that particular source of income will be allowed as deduction. So this is that generic deduction under 57, which is similar to section 37 of the PGBP head. Then comes the next item which has a capping. Again, this is in the form of a standard deduction. Now what this covers, so what you are earning is interest on the compensation. Now which compensation? So you had a land, you had immovable property which was compulsorily acquired by the government for the purpose of some project. So the government gives you compensation. First, see, the taxability of this compensation is generally capital gains chapter because that land may be your capital asset. Where the land is your stock in trade, it will go to PGP. But whenever this compensation is paid late, the government has to also give interest. Irrespective of whether the compensation is taxed under capital head or business head, the interest is always taxed under other sources head. Secondly, it is taxed in the year of receipt. So it may happen that accumulated interest of 7 years is taxed now because you have received the compensation late by 7 years. Now, this interest of 7 years will be taxed in the year of receipt, and you have a flat or a standard deduction of 50%. But no deduction will be allowable under any other provisions of this head and section 50. So this is about that compensation part, that the initial compensation, enhanced compensation is taxable under capital gain, and the interest will be taxable under other sources with a flat deduction of 50%. Now we come to the section which creates some restrictions and disallowances. The provisions under 58 are again similar to what you have already studied in PGBP in different sections which put restrictions over there. Please read.
Deductions not allowable. Section 58. No deduction shall be made in computing the income from other sources of an assessee in respect of the following items of expenses. First, in the case of assessee, any personal expense of the assessee, any interest chargeable to tax under the act which is payable outside India on which tax has not been paid or deducted at source, any payment taxable in India as salaries if it is payable outside India unless the tax has been paid thereon or deducted at source.
So first is personal expense is not allowed. This is logical. And second is this is what is similar to section 40 clause A of the PGBP head, which says that where you are making payment of interest outside India or payment of salary outside India, and these incomes are otherwise taxable in India because of section 5, then it is your duty to deduct the relevant TDS before you make the payment. Now, if you have not deducted the TDS, the punishment under PGBP, the punishment under other sources is same, that the expenditure itself is not allowed as deduction. So wherever the payment has to be made outside India, you have to deduct the TDS. And if you fail to do so, the deduction is not allowed. Then comes a second disallowance, which is again similar to section 40 capital A, subsection 3 of the PGBP head, which says that whenever you are making payment of an amount of which you are claiming deduction, and that amount in a day pertaining to one single transaction, that is one bill, exceeds rupees 10,000, then the payment has to be compulsorily made by account, pay, check, draft, or one of the notified mediums, that is credit card, debit card, etc. If you fail to do so, then the amount paid will be disallowed in PGP head because of 40 capital A subsection 3, under this section because of 58 subsection 2. Then comes the next part, which is again similar to section 40 clause A, which says that wherever you are making payment of an expense and that is payable in India to a resident, then again wherever TDS provisions are applicable, if you either fail to deduct the TDS or after deduction you fail to deposit the TDS before the due date of filing your returns, then 30% of the expenditure is disallowed. However, here this disallowance is not permanent. If you remember, PGP had also, it comes with a relaxation that if you have not deposited the TDS in this period up to the due date of filing returns, in this period we will disallow the 30%, but it will be allowed in the future whenever you deposit this particular TDS. Similarly, second relaxation is where you have failed to deduct the TDS, but your recipient, that is the person to whom you are paying this income, has accounted for this income in his or her returns. That is, that person has already considered your payment as receipt and computed that particular source and discloses in that person's returns. Then, even though you have not deducted TDS, still you will be eligible to claim the deduction, because the purpose of this section is that government wants to ensure that your expense, which is somebody else's income, is taxed in that particular person's hands. So they ask you to deduct TDS, so at least the government receives the tax on that particular payment that you are making, which is somebody else's income. Now you fail to deduct the TDS, no problem. But if the opposite person is disclosing that in their returns, and computing income and paying tax, we will be allowing you this deduction. But here, practically, what will happen in the current year, that is a year of this expense, you don't get the deduction, you will get the deduction in the next year. And then comes this point which says that we will not allow you deduction for any of the casual incomes. This we saw already above. So for any incomes by way of winnings, there is no deduction which is allowed. One more thing, that is about carry forward and set off. We all know that there is firstly set off under section 7071. And if you are not able to set off a particular loss, you can carry forward it. Now, when it comes to other sources head, they only allow you to carry forward one source of loss, that is the loss arising from the activity of maintaining racehorses. Any other loss that you have under other sources can be set off in the same year, but it cannot be carried forward. Firstly, anything which is relating to betting, gambling, since there is no deduction allowed, there is no question of loss. So let us say you have put a bet and you lose the bet. So we say that is loss. Okay. But since the deduction is not allowed in the first place, there is no question of set off. So other than this, for remaining sources, wherever there is a loss, you can first claim it, adjust it in the same year, subject to the restrictions of 70 and 71. After having done that, if the loss is still there, then what we do in other heads cases, we carry forward it. This carry forward is not allowed for any loss under the head other sources except one loss. So only one loss under the head other sources can be carried forward. That is a loss pertaining to the activity of owning, maintaining racehorses, and the provision for its carry forward is section 74. And then comes section 59. 59 is equivalent to section 41 of the PGP head. Now, what is 41 and 59? Let us understand. The best example of this is bad debts. So, in some earlier period, let us say 21, 22 financial year, you had incurred some bad debts. Now, when you incur a bad debts, you debit your P&L, you claim it as an expenditure, as a loss, and even under income tax, they allow you deduction under the head PGBP. Now, if that particular bad debts was allowed as deduction in a particular year, and later on, let us say in current year, that bad debts, which was earlier shown as an expenditure as a loss and also allowed as deduction under PGBP head, if it is recovered, then since you have already claimed deduction of that, now if that amount is paid back to you, it is like reversing the deduction. So you should consider it, you should treat it as income under section 41. The same logic is there in section 59. Student, just give me a minute. Yes, students. So this point dealing with 59 is what 41 says. So how it applies in 59? So as we saw in 57, there are many provisions which allow you deduction for expenses, especially the general one, which says that any expenditure which is incurred for earning that income of other sources, except the ones which are restricted or which are disallowed, all other expenses can be claimed. Now, if let us say you have claimed an expense, and mainly it is always the common example is of bad debts only, and that is claimed as deduction by you, but that amount is recovered in future, it has to be taxed as deemed income under the same head. So if it is a PGBP item, it will be taxed as PGBP income. If it is other sources item, it will be taxed as other sources income. So with this, we have completed all the provisions. I'll just take you to the act also. So this is what we were discussing that day also when we started this topic. So as you can see, 56.1 creates a generic charge, but 56.2 is very specific and it has listed out what are the different incomes which would be specifically covered under this particular head. Yes, some of these incomes have a qualification or condition that they are not taxed under PGBP or under salary, but otherwise the remaining incomes are very specifically mentioned to be taxed only under this head. And hence, those incomes would always fall under the head other sources only. Right? Now, okay. So everything is covered here. Perfect. Now, since we have time, we can take up the cases firstly from other sources and then we'll go to even capital gains because that I had kept pending that day. So we can take up and discuss the various important cases which are relevant for your exams relating to both of these heads. Start beta. First one. You can directly read the issue and go to the analysis.
Issue. Can bonus share received by shareholders be taxable under the head income from other sources as per the provisions of section 56 to 10 as they are received without consideration?
Now, see why these cases have come up. We have to understand the background behind this. So, as you can see from the issue that Geet just read, the issue is that there is a conflict between two sections. What are these two sections? One, that when you are receiving bonus shares, now, firstly, also read it along with the definition under section 222, that is of deemed dividends, which we discussed in the previous class, where if you remember, we had discussed that bonus shares received by preference shareholders is taxed as dividends. So obviously we are not concerned with that bonus shares here because it is already getting taxed. So the second possibility is bonus shares are received by equity shareholders. Now that is not considered as deemed dividends. Now the question is, if you as equity shareholders are receiving bonus shares and that is not considered as income anywhere, can by any chance section 56 to 10 just step in? Now, what is 56 to 10? In very layman's language, we call it as gift received. Though, if you remember when we discussed this section, I'd explained that nowhere in the section the term gift is used, but for our simple understanding, we use this term saying that where you receive any property or money as gift, or you buy something for less than its adequate value, then it will be considered as gift and it should be taxed under 56 to 10. Now, when the company in which you are already a shareholder is giving you its own shares free of cost as a bonus on your existing shares, will it not fall in 56 to 10? This is what is the issue at hand. Now, this is an interesting point. Let us read the analysis, please.
The issue of bonus shares by capitalization of reserves is merely a reallocation of the company's funds. There is no inflow of fresh funds or increase in the capital employed, which remains the same. Thus, there is no addition or alteration to the profit making apparatus, and the total funds available within the company remain the same. On the other hand, when a shareholder gets bonus shares, the value of the original shares held by him goes down, and the market value as well as intrinsic value of the two shares put together will be the same or nearly the same as the value of original share before the issue of bonus shares. Thus, any profit derived by the assessee shareholder on account of receipt of bonus shares is adjusted by depreciation in the value of equity shares originally held by him. Hence, the provision of Section 56 to 10 would not be attracted in the hands of recipient shareholders on receipt of bonus shares. Note, the decision was rendered in the context of Section 56 to 7. However, the underlying principle emanating therefrom applies with equal force in the context of the present provision contained in Section 56 to 10. Accordingly, the issue and decision has been presented with reference to Section 56 to 10.
Now, just for your reference, what was 56 to 7? Now, 56 to 10 is the latest version. If you again remember this, when we were dealing with this section in the previous class, I had mentioned that originally the gift was introduced in the year 2004 under this head other sources. At that time, the clause was different. Then they amended it in 2010. And then they finally brought in this new section 56 to 10, superseding both the previous sections and clauses. Now, this decision, since it is an old one relating to the earlier transaction, which was taxed under the old clauses, but they have clarified that since the principle is same, since the analogy is same, the law point remains the same, only the clause is now different. So what they are trying to clarify that originally this decision is given under the scenario of the old gift provision, which was under 56 to 7. But you have to read it as applicable even to the present provision because the ideology is same. Now, interestingly, see, I'm not only interested in reading the answer or the decision. We as professionals should also evaluate and analyze for two things. One, how does this decision fits in the law? Because tomorrow this can be challenged, as we have seen that there are many times the decisions of one court which are being reversed by the other higher courts or by the same court with a higher bench. Two, how does this decision help us in applying the analogy to other transactions which may not be covered by this decision? So firstly, let us evaluate it from the point of the what you can say the application, what has been given. So the justification given is that even though you are receiving something free, so earlier let us say you had 100 shares, now the bonus ratio is 1 is to 1, so you are being offered 100 more shares, not offered, sorry, you are being given 100 more shares and all are free. So what you were having 100 shares, now it has become 200 shares. The question is whether receipt of these new shares should be taxed under 56 to 10. Now, if you see, literally it ticks all the parameter of 56 to 10. So you have received it free. Free means without consideration. So you're not paying anything to the company. Second, it is fitting in the definition of property. Yes. So it is property and it is received by you. So technically, you can say that it fits all the or it ticks all the parameters of 56 to 10, so it is taxable. But here I would like to present before you a very important point. See, whenever you are reading uh, an income tax provision, many times you will find that, especially in the judgment, the courts go behind the logic, the reasoning, the application. Means, what is the intent of the law? What is the purpose of making that particular clause? Here, I have one more additional justification besides what they are giving. So the justification that they have given is that since when you receive the bonus shares, the market value of your present share goes down. That is okay. But again, it is very generic because it may be different for different scenarios. But yes, definitely, the market value of your share pre and post bonus is different. Many times there is a market hype whenever bonus is declared and the present share values goes up. But the moment the bonus is given, the share value come down. But I still believe that this is only one angle of looking at this particular provision. I believe there is another angle of looking at this. That today when you are receiving these bonus shares, you may say that, okay, by the application of 56 to 10, there is some income arising to you. But we have to understand and appreciate this. This income is not a real income that is arising. The real income will arise only when you are able to encash the value of that shares. And that will happen only when you sell that particular share. And at that time, if you recall, the cost of acquisition for bonus shares will be taken as nil. So, whatever you get on the sale of these bonus shares fully will be taxed under the head capital gains. So, indirectly, the law is ensuring that there is no tax evasion. It will be taxed, but it will be taxed later in the future whenever these shares are getting sold. So, in principle, what they are trying to achieve from this particular decision or this particular analysis is that yes, even though you are benefited by receiving more number of shares, but in real terms, there is no benefit. What is this real terms? The real terms is that you have not earned anything more today, plus what was the present market value of the existing shares that has gone down. So effectively, you are not benefited or enriched. So let us wait till the time you actually realize this, and at that time you will be taxed for the whole value. So this is how they have taken the analogy to not tax it today, right? Chalo. Let us go to the second issue and the analysis.
Issue: is interest income from share application money deposited in bank eligible for set off against public issue expenses, or should such interest be subject to tax under the head income from other sources?
Now, firstly, I hope you all understood what the issue is. So, issue is that if you all know, now our IPOs are very hot subject today. So, if you recall the process which you may have studied in company law or even in company accounts, wherever you studied the topic on issue of shares, that firstly, the company invites application. Now, for inviting applications, there is some amount out of, let us say, the face value is 100. So, you have to pay some 10-20 rupees at upfront as application. Just a minute, should Sorry. So the company invites application along with, let us say, 20 rupees per share as application money. Now there are many people who are applying for this, but you all know, looking at today's this IPO trend, that many times these issues are oversubscribed. Now, there are specific guidelines given in the Companies Act that once you receive this application money within a particular time, you have to make allotments. Allotment means you have to decide to whom you will be finally giving the shares, allotting the shares, and whatever is the surplus excess application money, you have to return it back. Now, you do it within the time, so there are no interest penalty charges levied from the side of Companies Act. But even for that short period of time, when your application money which you have received, which is in multiple thousand crores or at time multiple lakh crore, that is in your bank account, and even for a very short period, you may earn a decent few lakhs of rupees as interest if the amount is in multiple thousand crores or in multiple lakh crores. Because per day interest also, if the bank is calculating and giving, it will be a good amount, a substantial amount, 5, 10, 20, 50 lakh rupees. Now the question is, first question is whether this interest is taxed under other sources or PGBP, etc. Second, what deduction can be claimed against this? Now, what this particular case covered, that whether the interest income from share application money bank is eligible for set off. Set off means can you deduct or adjust the public issue expenses. So whether that expenses, because now why they have used the word set off, please understand this also, because in this case, the company had just started. So it is not that it is bringing some IPO when the company is in operation. It is starting. So it is the very initial offer. And right now, the company has not yet done any operation. So there is no business, there is no profit. Now, definitely, whatever expenses the company has incurred for bringing out this issue, all that expense is a loss. So that is why the word set off is used. Can that loss be set off? And whether it will be taxed under the head other sources. Please read.
The assessee company was statutorily required to keep share application money in a separate account till the allotment of shares was completed. Part of the share application money would normally have to be returned to unsuccessful applicants, and therefore the entire share application money would not ultimately be appropriated by the company. The interest earned was inextricably linked with the requirement of raising share capital. Any surplus money deposited in the bank for the purpose of earning interest is liable to be taxed as income from other sources. Here, the share application money was deposited with the bank not to make additional income but to comply with the statute. The interest accrued on such deposit is merely incidental. Moreover, the issue of shares relates to capital structure of the company, and hence the expenses incurred in connection with the issue of shares are to be capitalized. Accordingly, the accrued interest is not liable to be taxed as income from other sources, and the same is eligible to be set off against public issue expenses.
So again, this part is very interesting. So what it says, the share application money was deposited with the bank not to make income, but to comply with statute. So as we discussed that you have to keep it in a separate bank account, and after allotment, you have to return to the unsuccessful bidders. Now, the issue of share relate to capital structure of the company, and hence expenses incurred in connection with the issue of shares are to be capitalized. Accordingly, the interest is not liable to be taxed as income from other sources. Rather, the same is eligible to be adjusted against the public issue expense. So we will be capitalizing the public issue expenses. That is the expenses in connection with issue of shares. So it will be capitalized net after adjusting these incidental income. Yes, Swaminathan.
Sir, actually, when the company is collecting the application money, they will deposit, they will open the special account in the bank. Generally, the company, no, when they will have the current account. See, this type of money put in any saving account or term deposit. How
Sorry.
can they
Your voice is breaking.
my
No, your voice is still breaking, Swaminathan.
call, that is the reason. Okay, I'm disconnected the call. Sir, am I audible now, sir?
Perfectly audible now. Tell me.
Right. That time I'm receiving call. I didn't notice that. It is in silent mode. Sir, my question is that whenever the share application is money received, definitely the company will open that special bank account. See, that
Correct.
is not saving account, not term deposit account. See, the
Correct.
thing is, generally those account will not provide the interest at all.
Hmm.
How in this, how it is possible to get the interest on this case? That is what my basic question is.
See, what you are saying is what is the present scenario. See, when all these things were in the initial stages, at that time there may not be such restriction and person may have earned interest, because otherwise this case would never have come on board. Correct. So I agree to your point that there may not be interest, but maybe in the initial period there would have been a possibility where people would have got some interest, and hence we are having this particular question. Correct, na?
Right, sir. Okay, fine. This question is dealt with in 2021 only, but this particular application money when they received, but
It
the
would be
exact.
even it would be even earlier, because in 21 you got the judgment.
Yeah. That I understood, sir. But the exact fact of the case would not known. That is
Nee,
okay.
but see, one thing is by default a presumption na, that they have received interest. Otherwise, this question would have never come up.
Right. That is sure actually. The
Yes.
primary evidence is that since they received the interest, that's what the debate came in.
Exactly. Exactly. Perfect.
Right, sir. Right.
Yes. Yes, Geet. Next.
Is interest on enhanced compensation under Section 28 of the Land Acquisition Act 1894 assessable as capital gains or as income from other sources?
Now, this is interesting because we have already seen that interest received on compensation wherever there is a compulsory acquisition of land is taxed under the head other sources. Now, this is already clarified or clearly given in the law, but still we have this specific question. Why? Because it is relating to section 28. Now, for this, unfortunately, we don't have section 28. So we'll do one thing, we'll just read the analysis. Let's see if we can get some analogy from there.
The assessee has received interest under Section 28 of the Land Acquisition Act 1894, which represents enhanced value of land and thus partakes the character of compensation and not interest. Hence, interest under Section 28 is liable to be taxed under the head of capital gains and not under income from other sources. On the other hand, interest under Section 34 of the Land Acquisition Act 1894 is for the delay in making payment after the compensation amount is determined. Such amount is liable to be taxed under the head income from other sources.
So this is what is the main crux, that where it is under 28, it is not for the late payment, it is for the enhancement in the value. And since it is for the enhancement in the value, it partakes the character of compensation and not interest, and hence that will go in capital gain itself. However, when it is under section 34, it is in the nature of late payment compensation. That is, it is in the nature of interest for delayed discharge of this consideration or compensation, and hence in that case it will be other sources. Perfect. Go ahead.
What are the tests for determining substantial part of business of lending company for the purpose of application of exclusion provision under Section 222?
Now, what is this? So see, this point is, we studied the definition of dividend, where in case of 222E, where a company is giving a loan advance deposit and the company is a private company and the shareholder is holding 10% or more of the shares, then we discussed that, or we saw that it will be considered as deemed dividend, but it had an exception, that where the business of the company itself is money lending, to which we said that it is a bank or something. So in such cases, there was an exclusion. Section 222E would not apply. Now, this particular case is particularly related to that particular explanation or that particular exclusion, whereby if a company has as a substantial part of the business lending of money, this is the phrase which is used, and under this particular case, this phrase is under challenge ki what will be meant by substantial part of business, because I may not have registered myself as a bank, but I may still be lending money, or I may be a regular manufacturing company, but I regularly give loans to my employees at some nominal interest. Whether this could be termed as substantial part to give me the shelter of not being treated as deemed dividend under 222E. That is the whole question under dispute. Please read.
Under Section 222, dividend does not include inter alia any advance or loan made to a shareholder by a company in the ordinary course of its business, where the lending of money is a substantial part of the business of the company. Percentage of turnover in relation to the whole, as also the percentage of the profit in relation to the whole, and sometimes even percentage of manpower used for a particular part of the business in relation to the total manpower or workforce of the company would be required to be taken into consideration for determining the substantial part of business. The capital employed for a specific division of a company in comparison to total capital employed would also be relevant to determine whether the part of the business constitutes a substantial part.
So they have interestingly given some criterions for determining. So first criterion is turnover. So out of the other activities that the company is doing and getting some turnover, how much turnover the company is getting from the interest. So they are saying that you can check the percentage, though they have not given any cutoff as to how much the percentage should be to make it a substantial part, but they have seen first criterion can be percentage of turnover. Second, percentage of profit. So out of your total profit earned by the company, how much profit is attributable to lending activity. Further could be how much part of your workforce is devoted to this particular activity, and also how much part of the capital employed of the company is for this particular division or this particular activity of money lending. So they have in this particular case given you different parameters to decide. So it is subjective. What will be the when we will say that money lending is a substantial part of your business. So they have given criterions to determine. Please, next.
Can repair and renovation expenses incurred by a company in respect of premises leased out by a shareholder having substantial interest in the company be treated as deemed dividend?
Now see how issues come up, and that is where it is interesting to also see how people look at the provisions. Either they interpret or purposefully they misinterpret for a benefit that they want, and this is where the interpretation of the provisions becomes very important, or the intent, I should say, more than interpretation, the intent. Now what is the scenario? So there is some repairs renovation expenses which is done by the company, and it is done by the company in respective of premises leased out by a shareholder having substantial interest in the company, whether this will be regarded as dividend. Now this is where there is one small assumption, which I'm sure would be the part of the facts of the case, that the leased out premises, that is the shareholder has leased out the premises to the company only. It means the company has taken the shareholder's premises on rent, and in that, the company is undertaking renovation or repair expenses. Now, where the company is doing some expenses on the property of the shareholder and all other criteria of 222 is satisfied, the question is whether these expenses done by the company on the property of shareholder be treated as deemed dividend under 222E, or for that matter under any of the clauses of 222, not only E. So for this, you have to read each and every clause again. Clause A says where the company distributes any assets. Clause B says company distributes its debentures or shares. Clause C and D are specific to liquidation or reduction. Clause E is where the company has given any loan or advance. That the terminology is very important. And the newly added clause F, which is applicable from very recent period, is wherever there is buyback. Now, definitely buyback is not there, so that is ruled out. A B, C, D are also ruled out because they are not fitting. Yes, Maxim, you can just check A also because, but still, I don't think A will also trigger. So mainly it is revolving around E only. So can you say that the company has given any loan deposit advance, right? Please read.
The expenditure incurred by virtue of repairs and renovation on the premises cannot be brought within the definition of advance or loan given to the shareholder having substantial interest in the company. Though he is the owner of the premises, it cannot be treated as payment by the company on behalf of the shareholder or for the individual benefit of such shareholder. Accordingly, the repair and renovation expenses in respect of premises owned by the shareholder having substantial interest in the company and occupied by the company cannot be treated as deemed dividend.
So as I said, the premises are occupied by the company. Now see, had you not taken this premises of shareholder, but you have taken it of some outsider, then what would be the scenario? We already have section 30 and 31 of the PGBP head, which allows you to claim deduction of repair expenses on building or plant machinery and other assets, either owned by you or even taken on rent by you. So whenever you are incurring expenses on repairs, they are specifically allowed as deduction under 3031 of the PGBP head. This itself is the first, I can say, proof to say that there is no problem with you incurring such expenses on rented premises. But then the second challenge is where these expenses are incurred on property which is originally of the shareholder. Whether the scenario will change, the answer is still no, so far as you are able to prove that the expenses incurred by you, firstly, are in such a nature that it benefits you only. Because why you are doing repair renovation? Because you have taken that property on lease. Now since you are occupying and using it, if you want to use it in a proper manner, you have to incur that expense. Second, you have to also justify that by doing these repair renovation expenses, it is not indirectly benefiting the shareholder. For example, this is the last year of lease, and just when the lease is about to expire or terminate, now you are incurring some expenses on repairs, and which is a substantial amount, or which is like a sort of a capital repairs which will have a long-term benefit, then maybe the answer can be different. But if it is in the regular course, and if there is no such indications to prove that by doing this repairs you are in any fashion doing it for the benefit of shareholder, rather it is for your own, what terminology we use, commercial expediency, that is for your own business benefit you are doing it. Had it been a third party premises, still you would have done it, and here you are doing it in your shareholder premises. That will not change the scenario, and it cannot be treated as any special benefit given to the shareholder. Yes, please proceed, Beda.
Can the loan or advance given uh, okay, can the loan or advance given to a shareholder by the company in return for an advantage conferred on the company by the shareholder be deemed as dividend under section 222E?
Okay, now again, a very specific scenario. What it says, loan advance given to shareholder. So first part is satisfied. Now you have given a loan only. But what is the different part is in return for an advantage conferred on the company by the shareholder. Now again, the facts have to be seen. What is the advantage conferred? But the point is that there is something in return that the company has got. So let us say the shareholder has helped company crack a deal. So through shareholders' influence, the company got a deal. A company got a very good business opportunity. So let us say this is one of the advantage. Now, against this, that is in return for this advantage, the company gave a loan. Whether this will be dividend under 222E. Please read.
The phrase "by way of advance or loan" appearing in section 222E must be construed to mean those advances or loans which a shareholder enjoys simply on account of being a person who is the beneficial owner of shares, not being shares entitled to a fixed rate of dividend, whether with or without a right to participate in profits, holding not less than 10% of the voting power. In case such loan or advance is given to such shareholder as a consequence of any further consideration which is beneficial to the company received from such shareholder. Such advance or loan cannot be deemed as dividend within the meaning of the Act. Thus, only gratuitous loan or advances given by a company to a shareholder who is the beneficial owner of shares holding not less than 10% of the voting power would come within the purview of Section 222E, but not cases where the loan or advances is given in return for an advantage conferred upon the company by such shareholder.
See, again in this, they have tried to go to the intent of 222E, whereby, see, again, none of these things are specified in 222E. 222 is very plain. Wherever the company, which is a private company, gives loan advance to a shareholder having 10% or more, it will be straightforward deemed dividend. In fact, if you remember, we even studied that later on in future, even if the loan is repaid, even if it is paid with interest, still it will not change. You will still tax it in the year of loan, irrespective of whether in future the loan will be repaid. Now, here, this particular judgment is trying to overstretch, and they are trying to take a position which says that the intent of the law is that only you being a shareholder was the reason for giving you the loan. If you have done something in return, that will not trigger 222E. This is how the Honorable Court has interpreted. I believe this is a very ambitious interpretation, and I don't know whether this is further challenged in Supreme Court or not. We'll have to check, but this is a very old 2011 judgment. So, but this is a very ambitious interpretation, because again, it will be very difficult to say that. See, because one thing is clear, let us say even if the shareholder has done some benefit to the company, so company may or should have paid some charges for that. But if the company is giving loan, the only benefit that you can say the company is giving to the shareholder is by not charging interest. So that is the benefit which the shareholder is getting. I still believe this should be taxed under 222E. This is my interpretation or reading, but fine. The judgment is saying otherwise, so we'll go by the judgment. Yes. Next one.
Would the provisions of deemed dividend under Section 222E be attracted in respect of financial transactions entered into in the normal course of business?
I think this answer was already there in the circular, right? Where there was a circular which we read saying that where there are trade loans or where it is a necessity, like I gave you example that I am a distributor of Britannia company and also a shareholder. And in that case, because of some business compulsions or as a trade practice, there is some loan being given that will never fall under 222E because it is a trade practice. It is part and parcel of the uh, what you say, the word used over here is normal course of business. I think that same would be here. The assessee was involved in booking of resorts for the customer of the company and entered into normal business transaction as a part of its day-to-day business activity. Such financial transactions cannot under any circumstances be treated as loan. So where as a part of your business activity, if you are getting any deposit or any loan, then that will not tantamount to dividend under 222E. Yes. Next one.
Can winnings of prize money on unsold lottery tickets held by the distributor of lottery tickets be assessed as business income and be taxed to normal rates of tax instead of the rates prescribed under Section 115BB?
Now, this is interesting. I'm sure you understood what the issue is. So the issue is that you are the lottery ticket seller. Now, you had purchased 500 lottery tickets. Let us say the lottery draw date is 25th of September. But by 24th or even 25th evening, you were able to sell only 400 lottery tickets. So you have 100 unsold lottery tickets which are held by you. You are the distributor of lottery tickets. Now, whatever income you get from purchase sale of lottery tickets, no doubt it is your PGBP income. But out of these unsold lottery tickets, actually one of the lottery is there. And let us say the lottery department or whoever is running the lottery has no such restriction that only they will give lottery to the sold out lottery tickets. So even for unsold lottery tickets, if it is in the possession of the uh, distributor or the seller of lottery tickets, they are still giving away the prize money. Now the question is, you received the prize money on one of the unsold lottery tickets because that lottery came up in the draw. Now this will be treated as winnings for you, or since it is part and parcel of your business to purchase a lottery, so this is an income incidental to business and it should be taxed under PGP. See, the main difference would be the tax rate. And also under PGP, you are eligible to claim other deductions, losses, set off. Here, if it is taxed under other sources as winnings, there is no benefit. It is tax gross and that also at a higher rate. Please read.
The receipt of the prize money is not in his capacity as a lottery distributor but as a holder of the lottery ticket which won the prize. The lottery department also does not treat it as business income received by the distributor but instead treats it as prize money paid on which tax is deducted at source. Further, winnings from lotteries are accessible under the special provisions of Section 115BB irrespective of the head under which such income falls.
So it is very clear that since there is specific provision on taxability under 115BB, that is where it is irrespective of the head. So even if you want to treat it as business head, no problem. Still 115BB will apply. This is what is important because 115BB is independent of head. When you read the provisions given in 115BB, which provides for that special tax rates and says that no deduction, etc., will be allowed, that is independent of which head you are covering it under. So that is what is the relevance. Fine. So we complete other sources. Now, after the break, we'll take up the case studies of capital gain chapter. So let us have a break of around 10-12 minutes. So it is 7:33. We meet at 7:45. Fine. Thank you. Would somebody else like to read? Or should I continue with Geet? Okay, Geet, you may continue, Bada.
I think Geet is reading perfectly. We
No,
can ask.
that is why I asked if somebody else can read. I think Neha. Yes, Neha, Bada, please.
Good evening, sir.
Good evening, Bada. You have to read the issue and then we'll analyze and discuss on the second part.
Okay. Can any transaction which enables the enjoyment of immovable property be considered as enjoyment as a purported owner thereof or being treated as a transfer of a capital asset under section 247(6) and levy of tax on capital gains arising therefrom?
Okay.
And
Now, let us first understand what the issue is before we can take up the analysis. So we know that section 247 defines transfer, and in that the last clause says that whenever there is any transaction whereby you give the rights of enjoyment of immovable property to anybody, that will also be deemed to be transfer. Now basically let us first understand what does that clause 6 covers. So you have a flat in a housing society. Now if you know the housing society laws, according to the laws, even though you have paid for the flat, even though you say you are the owner, technically on paper, the legal owner is the housing society itself. Now, when the housing society is the owner on paper and you have to now transfer this flat, how do you transfer? So effectively, since you are not the owner, the legal owner, you cannot prepare the document of sale of flat. So how this whole mechanism is set up? So let us say there are 50 flats. So the housing society will have 50 shares. And by transferring your share, so effectively what you are transferring, at least on paper, is you are transferring that 10 rupee share certificate to, let us say, me who is buying this house. So on paper, what appears is the sale of shares transaction. But in effect, the transaction has the effect of transferring the immobile property and allowing the enjoyment of the immobile property. Now, this is what is clause 6. Now, here, this issue is related with clause 6. Again, the detailed facts are not there. So, maybe after reading the analysis, we can get the facts. Yes, Neha Bida.
analysis and decision. Any transaction which has the effect of transferring or enabling the enjoyment of any immovable property would come within the of purview under section 247(6). Section 247(6) appears to be to bring within its text net a de facto transfer of any immovable property. The expression enabling the enjoyment of takes color from the earlier expression transferring, so that it is clear that any transaction which enables the enjoyment of immovable property must be enjoyment as a purported owner thereof. The idea is to bring sorry there is the idea is to bring within the text net transactions where, though title may not be transferred in law, there is substance a transfer of title in fact. In this case, the assessee's right in the immovable property were extinguished on the receipt of the last check. Further, the compromise deed could be stated to be a transaction which had the effect of transferring the immovable property in question. Accordingly, the transaction fell under section 247 second and 6. Hence, it is a transfer in relation to the capital asset and capital gains tax liability would be attracted.
So, again, the facts are not very clear from what we read. But basically, the point is that merely if I allow you to enjoy my property, is that sufficient to fit in clause 6? The answer is no. So when you read this section 247 clause 6, it requires that there has to be in effect a transfer also. So as I gave you first example, the first example is on paper I am selling the share, but in effect the transfer of the flat happens. So from today I start occupying the flat, I start enjoying the flat, but more importantly I am enjoying as an owner. Now if you merely give someone a flat to use or to occupy as a tenant, that will not fit in clause 6. That is what is the basic discussion point over here. Fine. Let us go to the next issue. Please read, beta.
Yeah. Case Balkrishna versus Union of India and others. Issue: would receipt of higher compensation after notification of compulsory acquisition change the character of transaction into a voluntary sale so as to deny exemption under section 10 subsection 37 clause 3?
Okay, fine. Now, firstly, 1037 is not subsection, it is clause. Right? So you'll read it 10, clause 37, subclause 3. Fine. Acha, do you all know how do we come to know whether it is to be read as subsection and when we have to read it as clause? Sure, something about reading of law. Because I just corrected Neha saying that you should read it as clauses, not as subsection. So how do we know this?
So, subsection comes under section and clause comes under subsection.
Correct, but here when you read it as subsection, I
Yeah,
corrected you
yeah,
saying
by
that
mistake. Actually, I read it.
no. You are not, you did not make a mistake, beta. My point is when you are reading this, how will you know that you should read it as clause 37, not subsection 37? So what you did, even though I corrected you, but there is some logic. Like in some other case, you will read it as subsection 37 only. But here I said, don't read it as subsection, read it as clause. Are you getting my point? So students, my question is, whenever you are reading a section number like this, how do you know I should read that 37 as subsection or I should read the 37 as clause 37? Geet, you're right, but you are giving me not the reasons for it. You're just giving me the actual answers. Very good, Chitra. See, what Chitra has said, I'll put it in more simpler words. So there is a section, any section you can take, and then there are sub-parts of the section given some numbers. Now the question is, all those numbers which are given, whether they should be called as subsection or whether they should be called as clauses. First rule, if the numbers given are alphabets A, B, C, D, or they are Roman numbers, then be assured they are always clauses and subclauses. They cannot be called as subsection. So one thing is clear, if the numbers are in alphabets, so the numbering given is A, B, C, D, or the numbering given is Roman 1, Roman 2, Roman 3, they will always be called as clauses and subclauses. But when the numbering is given like this, 37, which is the, which number is 37? Like this is Roman 3, na? Again, an interesting point, just for value addition. We call this as Roman 3. So this 10 and this 37 is which number? If the 3 is Roman, so what is this 1037? Which number it is? Yes, students. Some very basic question. Chalo, that is your homework. I'll not answer that because anyways it is not part of my subject. So I'm not bound to answer. So you can just search it and maybe you will get it from kids' books. So when they start learning maths, the answer is there. Chalo, now coming to my point, that when the numbers are not in alphabets ABC or Roman, like here 1037, it is neither alphabet, neither it is Roman number. How do I know? whether I should read it as subsection, because this can be called a subsection also and it can be called as clause also. Here I said it is clause. Why? So when I'm reading section 10, I have these subparts of 10 like 1, 1A, 2, 2A, B, C, D, then 3, then 4, then 5, then 6, then 7, then 8, in 8 again A, B, C, D. Now all these sub-points of section 10, what are they covering? They are covering all exemptions. Like subsection 1 is for agriculture income. Subsection 2 is for HF share to its members, and 2A is for partnership share to its partner. So that list you have. Now the question is, when you read point 1, which is agriculture income exemption, you read point 2, which is HF share to members, you read point 2A, which is partnership share to partners. Are these points all falling under section 10? Are these related to one another? That is 1, 2, 2A, 3. Are they all connected? Or they are all independent? Tell me.
They are all independent, sir.
Perfect. So whenever the subparts of any section are independent, they are not subsections, they are clauses. But when the subparts of a section are related, that you will find in many other sections. Now, what do you mean by related? You cannot decide anything only by reading part 1. You have to also read part 2, you have to also read part 3, or you have to also read part 4. Then only you will get the complete answer. So the complete answer is after reading all parts. Complete, or I should say, one part is not complete. It has a connection with other part, with other part, with other part. Then we say they are not independent, they are connected, like all other sections. So like if you read the charging section 4, it also has subparts. If you read section 5, the scope of total income, it also has subparts. But one is not independent, because whatever one says, you have to also read 2, you have to also read 3. Then only you'll get the total understanding. Here, you can only read 10.1, that's sufficient. You know that 10.1 exempts agriculture income. For that, you need not read 2, 3, 2A, 4, etc. 1 is sufficient in itself. So 1 is independent, 2 is independent. They are all independent, so they are clauses. This is what is the reason or the logic of how to identify whether it is to be read as subsection or as clause. So Geet, what you mentioned at the start is correct. So in all definition sections, all the subparts in which different definitions are given are all clauses, because one definition, let us say in section 2, you have multiple definitions. They're not connected to one another. They are all independent. First definition, read, done. It has no connection with other definitions. It is independent. So all the subparts of section 2 has to be read as clauses. So 2.1, 2.1a, 2.2, and so on, all are to be read as clauses and not subsections. Similarly, section 10 over here, which gives you the exemption list, all exemptions are independent. So you will read it as clauses. Fine. Okay. Now coming back to our point of discussion. So here the issue is regarding compulsory acquisition. So there is a notification of compulsory acquisition. So there is, let us say, a notification given by the government saying that all lands on this particular patch will be compulsorily acquired, because the government wants to set up the bullet train track from here. It will pass from here. So all the lands falling in this particular area will be compulsorily acquired. Now, here the question is, since you received a higher compensation after this notification came, so let us say for some reason, the government decided to give you a higher compensation, higher than what is the standard provided in the Acquisition Act. The government decided to pay 20% higher, 40% higher. Will this change the character into voluntarily sale? Why this question comes? Because you are also happy. It means you are agreeing to that particular transaction. See, compulsory acquisition is something which is one-sided. Now, why it matters here? Because anyway, sale or a voluntary sale is also covered under 247 definition of transfer, and compulsory acquisition is covered. Both are leviable under capital gain. But the difference is, for compulsory acquisition, there is an exemption. Rather, there are two exemptions, one under 1037, one under 1037A. So where compulsory acquisition, like in 1037 is happening of an agricultural land in some specified cases, and you are individual HUF and you have actually done agriculture for 2 years minimum, then that compulsory acquisition is exempt under 1037. Now here the case is exactly that. But now the question is, since the government offered higher price and you agreed, so whether your act of agreeing will convert that compulsory acquisition into a sale, because the moment it changes to sale, you are not eligible for the exemption under 1037. That is what is the question. So the answer given is where proceedings were initiated originally under the Land Acquisition Act, even if compensation is negotiated. So let us say the government do not want that in future you go into court and again the matter gets stuck up, like presently also in many cases where the government is coming up with some sensitive projects. What they are doing, first they identify the area where they want to bring that project. Now instead of directly announcing and making it a one-sided step, they involve the local people, they negotiate, at times they offer better price, and then they say that okay, because we are doing it for this particular project, we are applying the Land Acquisition Act. So it is done under Land Acquisition Act, but despite of doing that, they are negotiating with you so that in future nobody goes to High Court filing some writ petition against that particular acquisition and then the matter gets stuck up. So many times when the government want it to happen fast, they, despite of using the Land Acquisition Act provisions, they come on table to discuss and finalize the amount specially. Now, in such cases, if they have discussed and negotiated and finalized the amount, will it change to voluntarily sale and hence not allowing you the exemption? That was the contention. So what is given? Merely because the compensation amount is agreed upon, the character will not change, because originally the action of taking your land is under the Land Acquisition Act. It always remains under the Land Acquisition Act. So only the compensation is discussed with you. All other things are still one-sided and all other provisions of the Land Acquisition Act applies. Hence, it still remains a compulsory acquisition and you are eligible for all the benefits which are accruing for compulsory acquisition. Please proceed.
CIT versus Dempo Company Limited issue. In a case where a depreciable asset building held for more than 24 months is transferred, can benefit of exemption under Section 54 EC be claimed if the capital gains on sale of such asset are reinvested in long-term specified asset within the specified time.
Now, what is the issue? Let us first understand. See, 54 EC exemption is applicable whenever a long-term asset is transferred and you invest the capital gain in the notified bonds. Now, here, what you transferred was a depreciable asset. It is a building. So you transferred that building. Now, interestingly, all the other conditions are satisfied, like the building is of more than 24 months, so it is a long term. But the challenge raised was, now you all know this, that whenever a depreciable asset is transferred, the gain or loss arising is treated as short term. I repeat.
Yes, sir. Yes, sir. It will be short-term capital only.
Correct. So section 229A defines what is long term. It says what is not short term, and 229B defines what is long term gain. It says gain arising from transfer of long term asset. Similarly, you have 242A and 242B defining short term asset and short term gain. Now here, if you go by the definition of asset, since the period of holding is more than 2 years, that is 24 months, it becomes a long term asset, no doubt. But because of specific provision under section 50, which says that whenever a depreciable asset is transferred, the capital gain arising on the depreciable asset shall be treated as short term. Hence this question, this confusion arose, because 54 EC exemption is only if you have transferred a long term asset. Now, interestingly, the building is transferred after 2 years. So the building per se is a long term asset, but the capital gain that you are getting on transfer of this building because of application of section 50 is to be treated as short term. So there is a conflict. Now the best part again is this judgment comes on the basis of the pure reading of the law. What the judgment says, we'll read also, but the judgment says that since the requirement of 54 EC is that the asset should be long term, which is transferred. There is no requirement that the gain arising from the asset should be long term. So, by applying the definitions of long term, short term, since the building, even though a depreciable asset, even though forming part of block of asset, since the building is held for more than 24 months, it makes the building a long term asset and the building remains a long term asset only because it is part of block of assets and a depreciable asset. As per section 50, the computation section, the gain arising on it is treated as short-term gain. It is not changing the nature of the asset. The asset, despite of all this, remains or holds the character of long-term asset. Hence, 54 EC still applies. This is the beauty. That is why this judgment is very interesting, because it makes you read the act and the words of the act minutely. Please read the judgment, beta.
The assessee cannot be denied exemption under Section 54 EC because firstly there is nothing in Section 50 to suggest that the fiction created therein is not restricted to only Section 48 and 49. Secondly, fiction created by the legislature has to be confined for the purpose for which is created. Thirdly, Section 54 EC doesn't make any distinction between depreciable and non-depreciable assets for the purpose of reinvestment of capital gains in long-term specified assets for availing the exemption thereunder. Further, Section 54 EC specifically provides that when the capital gain arising on the transfer of long-term capital asset, being land or building or both, is invested or deposited in long-term specified assets, the assessee shall not be subject to capital gains to the extent. Therefore, the exemption under Section 54 EC cannot be denied to the assessee on account of the fiction created in Section 50.
So, 50 is only creating the fiction on the nature of gain. It is not changing the nature of asset. And the requirement of 54 EC exemption is that the asset should be long term. So, since we are fulfilling the requirement, the asset remains a long term asset. Hence, they are saying that we will not deny the benefit. You can go ahead and take the exemption. Fine. Next point.
Issue: can advance given for purchase of land, building, plant and machinery tantamount to utilization of capital gain for purchase and acquisition of new machinery or plant and building or land for claim of exemption under Section 54G?
Now see, all these exemptions under 54, what they require is reinvestment. Now this is a very typical scenario. Let us say they are taking example of 54G. I am taking a simple example of 54. So I have sold my house and I want to purchase another house. This is for which 54 gives exemption. Now many times you know that what you are buying, if it is something like a immobile property like land, building, etc., there is a possibility that you are booking it while it is under construction. And many times it is possible that since the amount is huge, you may not directly pay the whole amount. So what you do is you pay a token or an advance, and later, after all the other things are like you have to put some paper ad, you have to check about the owner and everything. After all those things are done, after that only you finally do the purchase deed of that property. Now the point is, today I have, let us say, given 20 lakhs to the builder or to the person who is the property owner, and the builder is going to actually give me property after 6 months, 1 year, 2 years. In such a case, the question is, can this amount which is given to the builder or to the property owner, which is for the land building, which I have to purchase for the purpose of investment, but today I'm not receiving the land building. So this is only the money given like token advance. Can it be considered as investment, and can I be eligible for the exemption? That is the question. Please read.
For the purpose of availing exemption, all that was required for the assessee is to utilize the amount of capital gain for purchase and acquisition of new machinery or plant and building or land. Since the entire amount of capital gain in this case was utilized by the assessee by way of advance for acquisition of land, building, plant and machinery, the assessee is entitled to avail exemption or deduction under Section 54G.
So the point is, that since ultimately you will be actually getting the asset, that is the building, whatever it is. Hence, even though today you are only paying advance, even though today there is no actual amount, there is no actual property which is coming to you, still you will be eligible for the benefit because ultimately you will be getting that particular property. So that is what is this particular case dealing with. Again, a very practically relevant issue. Go ahead.
Can the amount incurred by the assessee towards perfecting title property acquired through will for making further sale be included in the cost of acquisition for computing capital gains?
So again, what the issue is, can the amount incurred by the assessee? Now, what has happened? I have received a property under will. So the property is received free. And even section 49 says the cost is cost of previous owner because I have not incurred any cost. But to get the property converted to my name and to get the title clear, I incurred some expenses of lawyer, court fees, etc., which is amounting to 2 lakhs. The question is, can this expenses be treated as my cost so that I can claim deduction whenever I'm selling this particular property? Please read.
The assessee had inherited the immovable property under a will, and the cost incurred by him for perfection of the title from perpetual leasehold rights to the complete ownership had to be regarded as a cost of acquisition within the meaning of section 48 and 55, as the assessee was transferring the complete ownership rights to the transferee and not the leasehold rights.
So in simple words, since when I've got the asset for the first time. So even though the asset was originally purchased by, let us say, my father who is giving to me under will, but I have got the asset today. So since I've got the asset today, for me, for getting the asset, I will require to get the title clear, the documents clear. So whatever expense I will be incurring for getting the title clear, that will be regarded as part of my cost of acquisition. This is what section 48 says, and this is what it requires, right? Go ahead.
CIT versus Manjula J. Shah. Issue. Would indexation benefit in respect of the gifted asset apply from the year in which the asset was first held by the assessee or from the year in which the same was first acquired by the previous owner? Decision is the indexed cost of acquisition in case of gifted asset has to be computed with the reference to the year in which the previous owner first held the asset and not the year in which the assessee became the owner of the asset. The benefit of indexation would be available for the capital assets which are transferred before 23rd July 2024.
Now, what is this particular point? I'm sure we all know this case. So where the property is acquired by you as gift, will, inheritance, where we take cost of the previous owner. The question is whether indexation will apply from your date, which is the literal reading of the indexation provision. However, this particular case law says that no, if you again go by the intent, since the cost is of a earlier date, the date when, let us say, your father acquired that particular asset and he is gifting it to you today. So since it is of earlier date, you will index it by taking the indexation rate of your father. So this is one of the renowned case which we already know. Go ahead.
Shakti Metal Depot versus CIT. Issues. Would the depreciable asset forming part of block of assets on which depreciation is being allowed since its acquisition change its character if it is not used for business purpose for the last 2 years to the effect that gain arising from its transfer be considered as long-term capital gain instead of short-term capital gains?
So again, this point is same that if an asset is a depreciable asset and it is part of block, whether the gain would be short term or long term. Please read.
The depreciable asset forming a part of block of assets within the meaning of section 2 clause 11 would not cease to be a part of the block of assets so long as the assessee continued business. In this case, the building forming part of the block of assets would retain its character as such. even if one or two of the assets in the block were not used for the business purposes in the last couple of years. Consequently, the profits arising on sale of such asset would be short-term capital gains.
Now, what is given? So this is interesting. It says that the depreciable asset forming part of the block within the meaning would not cease to be part of the block so long as the assessee continued so long as the assessee continued business. In this case, the building forming part of the block would retain its character as such, even if one or two of the assets in the block were not used for business purpose. So what it is trying to say is that there may be a possibility that in that block there are multiple buildings, but few of the buildings are now not used by you. Let us say you have given it on rent. So if they are not used by you and they are not part of business, this will not change the character since this particular building which you have sold is used for business. Hence, section 50 will apply. And since it is a depreciable asset, whatever is the gain arising on it, it will always be treated as short term. So that is because of application of section 50. Okay. Now this is again a very important case. Please read.
Would an assessee be entitled to exemption under Section 54 in respect of purchase of two flats adjacent to each other and having a common meeting point? The assessee is entitled to investment in both the flats purchased by him, since they were adjacent to each other and had a common meeting point, thus making it a single residential unit.
Now see,
Note.
what is this issue? I hope now you'll understand from the facts. Now section 54 says that you sell a house and you reinvest in house. And now they have put a condition that it should be a single house. If you want to purchase two houses, then they have put a monetary limit. Plus they have said that this will be allowed only once. Now here what has happened? You have purchased two flats which are adjacent to each other. And they are adjacent to such an extent that normally what you do, in order to make it a bigger flat, you remove the center wall. So both the flats get connected. Now, in such a case, it will make it a single residential unit. Now, the question is where you have this restriction that you should purchase only one house and two houses will be allowed only if it is below 2 crores, etc., etc. The question is in this particular case, since you have purchased two different flats and merge it into one, will it be considered as one flat or two flats? Please read. Even you can read from here.
Even in these cases, the benefit of treating adjacent flat as one residential house for the purpose of exemption under Section 54 would be available as per this High Court ruling. Furthermore, even in cases where long-term capital gains less than or equal to rupees 2 crore, the benefit of this case law can be availed and benefit of one-time exemption under Section 54 can be deferred and availed at a later point of time.
So what it is saying firstly, in these cases, the benefit of treating adjacent flat as one house for the purpose of investment under 54 would be available. So the point is that you now see, I'll tell you what is the logic. The logic here is that whenever you are purchasing, let us say, two different houses, but you can make a single entrance in such a fashion that tomorrow that both the house can be accessed by a single entrance, then there are multiple judgment which says that it will be treated as a single house and the benefit wherever the condition is of single flat will be available to you. So even if the builder has made two flats, but if you are able to make a single flat, but in such a fashion that both flat can have single entry and both can be used by that single entry, then we will consider it as one single flat for the purpose of the benefit. Go ahead.
Can exemption under Section 54 be denied solely on the ground that the new agriculture land purchased is not wholly owned by assessee, as the assessee's son is a co-owner as per the sale deed? The agriculture land sold belonged to the assessee and the sale proceeds were also used for purchasing agricultural land. The possession of the said land was also taken by the assessee, merely because the assessee's son was shown in the sale deed as co-owner. Deduction under Section 54B cannot be denied. Therefore, the assessee was entitled to deduction under Section 54B.
Now, here, as we all know, 54B applies where you have sold a agriculture land and purchase another agriculture land. Now here what is the issue? The possession of the said land was also taken by the assessee merely because the assessee's son was shown in the sale deed as co-owner. Now here what is the issue? Many times when we are buying a property, we buy it in the name of our family member. So let us say the scenario is I have sold my agriculture land. Again, this applies to other sections also. So I have sold my flat, but the new agriculture land or the new flat which I am buying, I am adding my wife's name in that. In this case, I am adding my son's name in that. Now, in this particular case, if I am adding some other person's name, but I have made payment for that flat, whether the exemption would apply or it would be denied saying that no, now the for the new flat or the new land, somebody else is also the owner. So the answer is the requirement is that your capital gain should be invested in the new flat. The new flat should be in your name is not the requirement. So even where the new flat is in somebody else's name, like you have added your uh, wife or your children, it will still be eligible for exemption. The exemption will not be denied for this mere reason. Yes, go ahead.
Can exemption under Section 54F be denied solely on the ground that the new residential house is purchased by the assessee exclusively in the name of his wife? For the purpose of Section 54F, a new residential house need not necessarily be purchased by the assessee in his own name, nor is it necessary that it should be purchased exclusively in his name. Having regard to the rule of purposive construction and the object of enactment of Section 54F, the assessee is entitled to claim exemption under Section 54F in respect of utilization of sale proceeds of capital asset for investment in residential house property in the name of his wife.
So, same continuing the above case. In the above case, what you did was you were also owner and you made your son joint owner. In this second case, you have exclusively taken it in the name of wife only. So your name is not at all. Now the question is still whether the exemption is allowed. The answer is same. The logic remains same. What is the logic? The logic is that since the amount of capital gain is invested, which is the main requirement, the problem is solved. So even though you are not the owner of this new house, but since the original house sold and the capital gain invested in new house, we will continue to give you the exemption. Go ahead.
In case of a house property registered in joint names, can exemption under Section 54F be allowed fully to the co-owner who has paid whole of the purchase consideration of the house property, or will it be restricted to his share in the house property? The inclusion of his wife's name in the sale deed was just to avoid any litigation after his death. All the funds invested in the said house were provided by the assessee, including the stamp duty and corporation tax paid at the time of the registration of the sale deed of the said house. This fact was also clearly evident from the bank statement of the assessee. Section 54F mandates that the house should be purchased by the assessee, but it does not stipulate that the house should be purchased only in the name of the assessee. In this case, the house was purchased by the assessee in his name and his wife's name was also included additionally. Therefore, the conditions stipulated in Section 54F stands fulfilled and the entire exemption claimed in respect of the purchase price of the house property shall be allowed to the assessee.
So, what is the point? Same scenario. What is the same scenario? The same scenario is that here again, for the purpose of 54F exemption, I purchase the house, but I invest means I put my wife's name also. So again, the point is whether it will be exempt. The answer is same. You have to ensure, pay attention. You have to ensure that the funds are going from your account. If the funds are going from your account, you will always be eligible for exemption, irrespective of whose name you are putting in the purchase deed. So this is consistently followed in so many decisions. So you can very well understand how much relevant it will be. Yes, go ahead.
Can exemption under Section 54F be denied to an assessee in respect of investment made in construction of a residential house on the ground that the construction was not completed within 3 years after the date on which transfer took place, on account of pendency of certain finishing work like flooring, electrical fittings of door, shutter, etc.?
Now, again, first understand what is the relevance of this case. So we know that the time limit given for construction. So if you are investing in new house in the form of construction, the requirement is the construction should be done in 3 years. Now the question is, if let us say some part of construction is left. So what is they are saying? Construction was not completed within 3 years after the date on which transfer took place. But why? On account of some finishing work. So whether the exemption can be denied saying that we had given the requirement that the construction should be completed in 3 years, but some work is pending. Please read.
The condition precedent for claiming the benefit under Section 54F is that capital gains realized from sale of capital assets should have been invested either in purchasing a residential house or in constructing a residential house within the stipulated period. If the assessee has invested the money in the construction of a residential house merely because the construction was not completed in all respects and possession could not be taken within the stipulated period, would not disentitle him from claiming exemption under Section 54F. In fact, in this case, the assessee has taken possession of the residential building and is living in the said premises despite the pendency of flooring work, electricity work, fitting of door and window shutters. Therefore, the assessee is entitled to exemption under Section 54F in respect of the amount invested in construction within the prescribed period.
So again, see what is the intention, what we get. As I said, now we have to understand and draw analogy as to what the decisions are trying to bring to us, because you can apply the same analogy in similar other cases. So what it says that you have made the payment. So the assessee has invested the money in the construction of the house merely because the construction was not completed in all respects and the possession could not be taken, would not disentitle. So see, the purpose again of all these 54 exemptions is that they want that you do the reinvestment. Now, if the reinvestment is done, now here it is beyond your control that the construction period extended. So that will not completely disentitle you. And in fact, in this case, they have said that the assessee has even taken possession. Now, if you have taken possession, then there is no doubt at all, because there is, see, the basic ideology is there should be ultimately a possession. So even if it is not happening within 3 years, maybe after 6 months, if you are finally occupying it, the purpose of the law is solved. So they will not be very rigid that you should actually start occupying it. So whatever you have spent in the 3 years on construction, that will be eligible. Go ahead.
Where the stamp duty value under Section 50C has been adopted as the full value of consideration, can the reinvestment made in acquiring a residential property which is in excess of the actual net sale consideration be considered for the purpose of computation of exemption under Section 54F, irrespective of the source of funds for such reinvestment?
Now, first understand what this issue is. Now, we all know if you are selling land building, you have to take your agreement value, add 10% to it, compare it with stamp value. If the stamp value is still higher, you have to take the stamp value. Now, let us say my stamp value comes to 5 crores and my sale value which I am showing is only 2 crores. So even if I add 10%, it is 2.2 crores, 5 crore is very high. So obviously my full value as per Section 50C will be 5 crores. Now 5 crores is full value. Let us say expenses on transfer is 50 lakhs. So my net consideration is 4.5 crores. Let us say my cost of acquisition is only 1 crore, capital gain is 3.5 crores. Now in this particular case, if I want to avail exemption of 54F, in case of 54F, I need to reinvest the net consideration, which in my example is 4.5 crores on the basis of the stamp value of 5 crores. But the actual money which I have got from sale of the asset, at least what I am showing is only 2 crores. Now, if I have to invest 4.5 crores for getting the exemption, definitely out of the money which I have actually got, I am investing 2 crores, balance 2.5 crores. obviously if I have to invest, I will be arranging it from other sources or from other funds. Means not the funds of this property which I have sold. So let us say I've sold a shop and now I'm investing in a house. So I want to avail 54F exemption. So here the question is, if I have utilized the money from other source, and in this case, it will happen by default. Why? Because your actual money coming from the sale of shop is 2 crores, but because of stamp value, the consideration 5 crores, net consideration 4.5 crores. So 4.5, you do not have funds because this shop has given you only 2 crores. So this extra 2.5 definitely will be taking from other funds, maybe by borrowing from someone, whether that would be considered as eligible for investment. Why? Because it is not coming out of the sale funds. It is coming out of from some other funds. Please read.
When capital gain is assessed on notional basis as per the provisions of Section 50C, and the higher value, that is the stamp duty value under Section 50C, has been adopted as the full value of consideration, the entire amount reinvested in the residential house within the prescribed period should be considered for the purpose of exemption under Section 54 Act, irrespective of the source of funds for such reinvestment.
So that is a simple point given. So the law requires you to reinvest. It is not saying that specifically the money that you have received from this shop should only be reinvested. And here practically that will not be possible because the shop consideration is less, and because of 50C, you have to invest some huge amount. So by default, again, the analogy that we are getting is the reading of 54 sections is only requiring that the reinvestment has to be made. There is nowhere at one-to-one correlation that it has to be exactly invested out of the sale money, right? Please proceed.
Can exemption under Section 54 EC be denied on account of the bonds being issued after 6 months of the date of transfer, even though the payment for the bonds was made by the SSE within the 6-month period?
Again,
In,
this point is very similar to the above point of that 3 years I was given to complete the construction. I spent amount on the construction, but I could not get the house within 3 years because the construction was not complete. What was the analogy there? No problem, you'll still get the exemption because you have invested in 3 years. Similarly, in 54 EC, the time limit for getting the bonds, or for not getting, sorry, I'll correct myself, for investing in the bonds is 6 months. Now, let us say I invested in the bonds, but I could not receive the bonds. Now, see, this particular point is where it is not in demat form, because today, anyways, there is no problem of receiving it. It gets created in your demat account. But let us say physically, for whatever reasons, delay, post, and all, I could not receive the bond within 6 months. Whether I not receiving the bonds within 6 months will disentitle me. If you draw the analogy from above point, you will get the answer. Please read.
in order to avail the exemption under Section 54 EC, the capital gains have to be invested in a long-term specified asset within a period of 6 months from the date of transfer, where the assessee has made the payment within the 6-month period, and the same is reflected in the bank account and the receipt has been issued as on that date. The exemption under Section 54 EC cannot be denied merely because the bond was issued after the expiry of the 6-month period, or the date of allotment specified therein was after the expiry of the 6-month period.
See, this is very much possible because the specified asset is a bond of some company. Now you have applied for the bond by making the payment upfront, but the company takes time. Their board of meeting happens some late, and after some period, which is after your 6 months period, they finally take a decision to allot you the bond, and you receive the bond. So both things, the allotment and receipt, both are happening after 6 months. Will it disentitle you? Answer is no, because from your side, what was required is making the investment, which you have done. So the analogy flowing across all these cases is same, that you need to make your part complete. What is your part? You need to invest. Once you have done the investment, then what is outside your control, like in above case, completion of construction, like in this case, allotment by the company. So that is not going to change the relief. Yes, ultimately, you should ultimately be getting the house or here the bonds. So ultimately, if you are getting, even though the actual receipt of the bonds or the house is happening after the specified period, still If the amount is invested within the specified period, the exemption is very much eligible. Yes.
Would sale of fertilizer bonds issued in lieu of government subsidy at loss be treated as a business loss or a loss under the head capital gain? Fertilizer subsidy given to an assessee to compensate the loss on sale of fertilizers should be treated as business income of the assessee. Due to cash crunch, the Government of India had discharged its duties of paying the subsidy by issue of fertilizer bonds. These bonds are sellable in open market and the prices of such bonds are varied. In this case also, the assessee received fertilizer bonds in lieu of subsidy, which was sold at a loss in the open market. Since the subsidy would have been treated as business income, loss on sale of fertilizer bonds issued is to be allowed as business loss.
Now again, see, this is again a very practical scenario. So as you would have understood the facts, so I am eligible for some subsidy from the government. Now, generally, subsidy should come in money form only, but at times where government does not have money, it gives you the subsidy by issuing some bonds, issuing some TDR receipts or something like this. So instead of giving money, it gives you some investment asset. Now, these investments assets are easily sellable in market. In fact, you will take that as subsidy only if they are sellable, because only then you can encash it and you actually sell it. But now, interestingly, the bond or the subsidy, let us say, was of 5 lakhs. So what the government issued you, the bond is towards 5 lakhs. Let us say the face value of that bond is 5 lakhs. But because of the varying market prices, you could realize only 4.5 lakhs. So now effectively what has happened, when you received the bond, you showed 5 lakh rupees as subsidy, which is received in the form of 5 lakh rupee face value bond. So you have already shown that 5 lakhs as your business income because it is a business subsidy. Now, after some time, when you actually needed the money, you decided, okay, let me encash the bond by selling in the market. So you sell the bond in the market, but it gets sold at 4.5 lakhs. So effectively, what is appearing in your assets is 5 lakhs bond getting sold at 4.5 lakhs. So there is a loss of 50,000. Now the question is whether this will be a capital loss, or since this was a bond received against your subsidy and which is a business subsidy, so this loss should be a business loss. Again, they have clarified that drawing this analogy, if you remember, there was a case up. So here also what they are saying, that since the purpose of this fertilizer bond is to give you a subsidy and the subsidy is a business receipt. So when you are encashing this bond, any profit or loss, here it is loss, it may be profit also, would be considered as arising out of the business only. And it would be considered as a business profit, business loss, and not a capital gain or capital loss. So this is how we interpret the different scenarios. As you can see, the different cases gives us very good insights, and these are only few of them. We have multiple such cases which are there. So this is what is the entire chapter, students. So from my side, we have completed exhaustively the entire chapter and all the parts of both the chapters. So I hope you all have understood everything. If there is any questions, query, you may please put it across to me. We will take up, we'll discuss that. Yes, students. Anything in both these chapters? Or for that matter, I'll say any chapter in income tax. We can take up that and discuss. Students, tell me.
Sir, in this case, case number 8, so my question is this, is it for 3 times same issue and same decision will be taken for the 2009, 13 or 11?
Sorry. I
Like
did
that
not.
name is CIT versus Sayed Ali Adil 2013, then CIT versus Ananda Bajpa. So
So,
uh, out of 3 means that is separately case for one by one or the consolidated cases in one time.
no. These are, see, in all the cases, the issue was similar and the judgment is same. So here our module has compiled all the cases. So all are different cases happening at different points of time.
Okay. Like year is mentioned 2009 or 11 or 13.
So they happen at different points of time, but they all were covering similar issue and had similar points. So we covered it at one place. Correct?
Okay. Hmm.
Yeah. Yes, students. Any further questions, students? Yes. Swaminathan?
Yes, sir.
No queries from your side. Did you read both the topics?
Yet to revise, sir. Then only I can have the doubt.
Okay. Okay. Fine. Anybody else has any queries or questions on any of this? Sanjay?
Clear as of now. No queries as of now.
Okay. Okay. Chitra? Any questions from your side, beta?
Sir, in case of that agricultural land, I mean, where there are limits specified, kilometers and population, why is it given as less than or equal to 6 kilometers and greater than 2 kilometers? They could have just mentioned less than or equal to 6 kilometers.
Acha. See, I understand. I got your point. So you mean to say that if the population is exceeding, I think it is 1 lakh or 10 lakh something, then they should have simply said 6 kilometers, right? But they have said that more than 2 and less than 6, correct?
Yes,
So I agree with your point, beta. Maybe I also would have preferred writing only less than 6, some not greater than 2 and less than 6, because that actually changes the meaning. So it means it has to be minimum 2. This is what you are highlighting, right?
I mean, if it's uh, within 2 kilometers but greater than 1 lakh
That's why I'm
population.
saying. That's why I'm saying. That is what is your point, and I agree to your point that that there was a no need to specify that it should be more than 2 and less than 6. So I also agree that it should be only 6. So answering your question, if it is less than 2 kilometers also, but the population is higher, you are still eligible for that. So it should not be said that it should be more than 2 and less than 6 only. Even if it is less than 2, it is eligible.
Okay, so if we read that now, as of now, it will still be considered as urban agricultural land.
Yeah, or means you are eligible. That's what I'm saying.
Okay, okay,
Means you will not consider it as. In fact, I'll say that in your case. So you're saying if it is less than 2, right? So it
yes.
is within 2 kilometers, and the population is more than that 1 lakh. Still, it will be considered as rural. This is what I'm saying. Are you getting my point?
How is it rural? But one minute.
Sorry, I got your point. Sorry, it will be urban, right? Because
Yes.
uh, that is the definition of urban area. Yes, so you're right. It will be urban, not rural. Correct.
Okay, so still within 2 kilometers, but urban.
Yes, 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 urban. Correct.
Okay, thank you.
Yes, students. Any further questions with anyone? No? So then we can conclude today's session. So thank you, students. Thank you very much. I'm sure both these topics, which are very, very relevant for your exams, would be having a good effect. So good effect in the exams, you'll be able to score. And most importantly, keep this in mind that it is not that you'll get only a specific question on this. It will be part of some major question like company assessment or assessment of individuals or partnership firm, where these things are useful. Plus, wherever there is only a case study type of question also, there most of these pointers that we discuss in both these cases will be useful. So please prepare it. If by chance for any reason you have not done it, please do it. And whatever are your queries, we can connect for the same. So with this, let us conclude today's session. Thank you, students. Thank you very, very much.
Thank you, sir. Thank you so much.
Thank you all.
Thank you. Thank you.
Thank you. Yes, Ashok ji, session.